The Federal Reserve has now cut rates for the third time this year, and it's projected that they're going to continue to have at least one more rate cut in 2026. Now, year to date, the market has already performed absolutely phenomenal. It's up double digits, and typically rate cuts are quite bullish. And in fact, if we just look at the market over the last 3 years, it's been difficult to not make money. Nearly everywhere we look, we see green. But what's interesting about the market right now is the fact that US equity risk premiums are in negative territory. This is extremely rare. We're essentially in uncharted territory. Now, what exactly does this mean? Well, basically it means the earnings yield on the S&P 500 is lower than the yield on the 10-year Treasury. When the equity risk premium has hovered around current levels, the S&P 500 has typically returned only around 2 to 3% over the following 12 months, well below its long-term average of the 8 to 10% range. So taking this into consideration, it's clear we have to be looking for opportunities in the market, and today we're going to be looking at 5 stocks at a 52-week low. Now remember, a 52-week low doesn't always mean the stock is undervalued, but it's a great place to start looking for value. So let's go ahead and dive in. But before we dive in, be sure to check out dividendology.com at the link in the description. I put out my best and plenty of free research on this website. When you sign up, you'll typically get around 2 emails from me a week. Again, you can simply click on the link in the description, or you can scan the QR code that I'm putting on the screen right now. Now let's dive into our first stock, and the first company we're going to be looking at is one that I've discussed on the channel pretty frequently. That's Novo Nordisk. Now what's so interesting about this company is, yes, they're up about 4% in the last month, and in the last 5 days, they've actually jumped up about 7.28%, but despite this, they're still very close to their 52-week low when you look at that 52-week range, because in the last year, the company is still down 54%. The company has halved its market value. So if you've been keeping up with the news, what's been going on with this stock, it's been quite hectic. Less than a month ago, the company saw a huge sell-off. You can see right here. And this came after the news that the Ozempic pill failed to slow Alzheimer's disease progression in large trials. Now, for a lot of people, this seemed to be a panic sell, and the market agreed because it quickly reverted back to where it was previously trading, and in the last few days, again, it's climbed even higher, up about 7.26%. Now, there's a couple of things we have to understand about Novo Nordisk. To start, if we simply look at them from a dividend perspective, we'll plug in their home country's ticker into the dividend breakdown sheet. What we can see is what looks like attractive dividend metrics. A starting yield with the sell-off is around 3.64%, and for reference, this is significantly higher than their historic average. Look where that starting yield has been for most of the company's history. For the past 5 years, it's been in that 1 to 1.5% range, so the sell-off has significantly boosted the starting yield, combined with the fact they've grown the dividend at a very high rate in the last few years, a 5-year dividend CAGR of over 22%, and on top of this, free cash flow over the last 5 years has grown at a rate of about 14.4%. If we jump over to our stock screener, again, let's look at Novo Nordisk in their home ticker. The data will load in, and like always, if you'd like to download any of these sheets and get access to the ticker data add-on in Google Sheets, then you can head over to tickerdata.com at the link in the description. Now, what we can see with Novo Nordisk is what everyone wants to see out of their holdings. Top and bottom lines have grown at a high rate, and what's particularly impressive is if we look at return on invested capital. Again, this is one of the key indicators of what most people would consider quality. Quality stocks are able to reinvest in opportunities and generate high returns on those investments. And this is telling us how profitable are the projects the company is using their capital on. Typically, as a baseline for most companies, you want to see 10%. High quality companies get around 20%. But Novo Nordisk is far above that, constantly getting above 40 or 30%. Why is that the case? Well, it's due to their business model. They're very capital light. We have to remember this is a pharmaceutical stock. You can see their industry and sector right there, a pharmaceutical company. So with that being said, why is the stock down 54% in the last year? Well, if you don't know anything about the company, they're currently in the midst of a huge competition, in a huge race. It's Novo Nordisk versus Eli Lilly. And they're battling to dominate the GLP-1 market, the obesity market. And this is something that Novo Nordisk has historically dominated, but it's clear Eli Lilly is starting to take market share. For example, if we just simply look at the valuation multiples charted out between these two, it's clear Eli Lilly on a price to earnings multiple basis looks way more expensive than Novo Nordisk right now. The PE multiple in 2024 for Eli Lilly was 65.6, Novo Nordisk about 27.53. But if we look at just the trailing 12 months, Eli Lilly at 49, Novo Nordisk now at 12.8. Why would there be such a massive discrepancy in the valuations for companies that are really competing for the same market, especially if Novo Nordisk currently has the majority of the market share? Well, it comes down to future earnings growth expectations. And this is why people are so upset with Novo Nordisk. At the beginning of this year, analysts and management from Novo Nordisk was projecting that they'd be able to grow top and bottom lines in the high teens. So we're talking about significant growth from Novo Nordisk. But management has now revised this downward 4 different times in the last year. Essentially, every time they release a new earnings report, they state they expect lower earnings and lower revenue growth. And as of right now, if we look at where Eli Lilly is with their 3-year EPS CAGR, it's projected to be about 24.1%. Meanwhile, Novo Nordisk is projected to be at 5.78%. So Eli Lilly is growing at a significantly faster rate than Novo Nordisk. At least that's what's projected. And if we look at the recent news just in the last day or two, Eli Lilly climbed higher on what they called best-in-class data for new weight loss therapy. So yes, while Novo Nordisk has historically dominated this obesity market, Eli Lilly is taking market share. Now, with that being said, has the sell-off been too extreme? Is Novo Nordisk an opportunity, now down 54% in the last year, down 42% year to date? Well, one of the things we can do is project what future returns could potentially look like by simply looking at a sensitivity model. Now, to project future returns, we need an EPS growth estimate and a projected future PE multiple. And we can see from 2025 through 2029, the projected EPS CAGR, according to the average analyst estimate, is about 7%. Again, this is one of the cool features of ticker data. You can automatically import the average analyst estimate for a multitude of different metrics. But this is one of my favorite to look at. 7% earnings growth. That's what's projected for Novo Nordisk. So let's just go with 7% for now. Now we need to project our future PE multiple. And we can see their current PE multiple is about 53% lower than the historic average. That is radically lower. So let's assume if they are able to achieve that 7% EPS growth rate, that we do see the multiple start to climb a little bit higher. Nothing outrageous and nothing close to where it's been over the last 10 years. Maybe it climbs to about 16. That would put it at slightly above historic market average returns over the next 4 to 5 years. If it climbs higher to about a 20 PE multiple, you can start to see there's outperformance potential. But here's the huge problem with Novo Nordisk right now. One of the reasons it's obviously trading at a discount is because of how much uncertainty there is surrounding this stock right now. And occasionally this is the case with pharmaceutical stocks, but it's especially the case for Novo Nordisk right now. When you have a management team revise guidance downward 4 different times in a single year, there's very little confidence that investors have in the company. And understandably so. We obviously can't feel too confident in analysts' estimates of 7% earnings growth when management has already revised estimates downward 4 different times. So is this an opportunity? Well, when you run the numbers, yes, the numbers look good. But the issue is there's just so much uncertainty about what even the next 2 to 3 years will look like for this company. Next up, we come to a real estate investment trust, Vici Properties, stock ticker VICI, trading at $28.12 per share, and for a while they were actually doing quite well in 2025 until around September hit. They're now down 10% in the last year, and if we look at the last month, they're down about 8%. Now, trading at this price gives them a starting yield of right at 6.5%. So what does that tell us? From an operational return standpoint, meaning combining earnings growth with the dividend yield, but in the case of a REIT, it wouldn't be earnings growth, AFFO per share growth. They would only have to grow AFFO per share at a rate of about 3.5% to drive total operational returns of around 10%. And what's interesting is with Vici trading at these prices, we can see this is the lowest price to AFFO per share multiple they've traded at in over 5 years. The current price to AFFO multiple is sitting right at about 11.51, while the average has been about 14.56. So definitely discounted compared to how they've historically traded. Now, if you aren't familiar with Vici, this is a real estate investment trust that has most of their real estate located in Las Vegas. And this is a large REIT. It's actually a part of the S&P 500, which not a lot of REITs are. And there's a multitude of things that really make it quite a bit more attractive than a lot of REITs, because there's certainly a lot of bad REITs out there. For example, they have 100% occupancy. 100% of their leases are triple net leases, which creates very predictable cash flow for Vici. Their tenants are responsible for things like maintenance and taxes. Their remaining lease term is over 40 years. And they also have inflation protection baked into their leases. By 2035, 90% of their rent roll will have CPI-linked escalation. Basically, if inflation goes higher, then the rent they collect goes higher as well. So why has the stock been selling off? Well, we could obviously point to a multitude of reasons, but there's one primary concern that I seem to keep seeing pop up. It's concerns surrounding Las Vegas. If we look at where Vici is collecting rent from, almost all of it is essentially Las Vegas, Caesars, MGM Resorts, the Venetian. These three tenants alone make up over 80% of their annualized cash rent. And they're all located in Las Vegas. And what do we know about Las Vegas over the last year or so? Well, for the first time in quite a few years, year over year, we're seeing lower visitor volume. October of 2025 compared to 2024, visitor volume was down by about 4.4%. Obviously, that's not great news for the REIT. At the end of the day, a REIT is only as good as the tenants in its portfolio, and those tenants are heavily impacted by visitor volume. But the market seems quick to forget just how well insulated Vici is for something like this, at least over the short to mid-term. But Vici is a triple net lease landlord, not a casino operator. We would have to go through a very prolonged period of time of seeing declining Las Vegas foot traffic for this to actually impact Vici Properties. For now, they're going to continue to collect the rent, and that rent is going to grow every single year that they collect. And as a result, their adjusted funds from operation is going to grow every year. And in fact, if we just look at their history, that is what's always happened, and it's projected to continue to happen according to the average analyst estimate moving forward. Vici's rents are preset, and they're escalating each year by around 2% on average. This is why the REIT's cash flow and dividend continue to grow even through the 2020 pandemic. A lot of REITs had to cut their dividend during 2020. Vici was not one of them. They collected 100% of their rent during 2020. So if anything, this tells us a short-term headwind is not really a headwind at all for Vici Properties. Las Vegas would have to see a prolonged period of lower foot traffic for this to actually impact Vici. And I certainly don't think there's currently enough evidence for that to be the case. And I certainly don't think there's enough evidence of that right now to assume that will be the case. So with that being said, for complete transparency, Vici's actually a REIT that I've added a few more shares of to my portfolio in the last few weeks. But I'll touch on that more later. Right now, if we simply look at Vici from a valuation perspective, let's look at a dividend discount model. We'll come down here and select the dividend discount model, and again, what we want to do is value the stock based on how much they're paying out in dividends and how much that dividend will increase in the future. Now, from what we're seeing from analyst estimates as it relates to their AFFO per share, it's projected to continue to grow. How fast is the question? Well, if we look at year-over-year projected growth rates, it's typically sitting in around that average 3 to 3.5, sometimes even 4% range. So if we go with somewhat of a midpoint and go with about 3.5% growth, all of a sudden you can see Vici would be worth $36.17 per share, giving them over 28% upside from their current share price. What's interesting about that is that actually lines up close to what we're seeing with the average analyst estimate. The average analyst based on 11 ratings is giving them a price target of $34.33. So even if AFFO per share growth is closer to around 3%, there's still significant upside. We're talking about double-digit upside at about 16%. Even if it drops to 2.5%, we're still seeing upside. So I do think there's some margin of safety with Vici Properties right now. Next up, we have a stock that historically has been talked about pretty frequently by a lot of investors, but I haven't seen it discussed a lot lately, and probably the reason is the fact it's down about 12% in the last year, and if we look at them year to date, down about 4.4%. That's Costco, currently trading at $884.48 per share, and they are right on the low end of that 52-week range. Now, fortunately for us, this company just released their latest quarter's earnings report, so we'll get the chance to dive into it. So let's do exactly that. Now, to start, we can see they actually saw beats on top and bottom lines. This was Q1 of their fiscal year 2026, and they saw a beat on earnings of about 22 cents. Revenue was up 8.2% year over year and was a beat by about $190 million. So overall, that's obviously great news, and if you're not familiar with this company, the business model is truly phenomenal. And in a moment, I'll show you why, but for now, let's just look at some of the fundamentals. If we go ahead and zoom out, let's look at the dividend breakdown sheet and look at Costco. Now, what we can see is, yes, the starting dividend yield is low, but it's not a perfect representation of how they reward their shareholders, because what we can see here is a trend. When Costco starts sitting on heavy cash positions, what they'll do is they'll pay out a large special dividend. In 2023, the total dividends paid out was $18.96 per share. For example, the previous year it was just $3.49. So they pay out those dividends opportunistically. Yes, the underlying dividend is growing every single year, but they're not afraid to pay out special dividends. The reason they're able to do this is free cash flow has been growing at double-digit rates over the past 5 and 10 years. If we jump over to the stock screener, look at one of my favorite things about this stock. Investors love investing in companies that have extremely predictable cash flows. Look at revenue per share for Costco. Every single year, it only goes up. Every single year. It's very stable. There's not a lot of fluctuations. And the same is true with their earnings per share as well. This is one of the reasons that we see the stock trade at a premium. Now, the question we have to ask is what type of business model do they have that actually allows revenue per share and earnings to look like this? Well, let's dive into it just a little bit more. Let's look at the recent earnings report and see what we can take away. Now, to start, we can see things like, yes, comparable sales and adjusted comparable sales up by about 6.4%, but that's not the reason the cash flows look as predictable as they do. The real reason is right here. Costco sells memberships. And when we're talking about a membership company, not only do they want to grow memberships, they want to retain their current members, ideally at a very high rate. That's the key to the success of their business model. And their worldwide membership renewal rate is sitting right at 90%. So they have extremely loyal members. What this means is when they exercise their pricing power, increasing membership costs like they did not too long ago, and they still retain the majority of their members, it causes top and bottom lines to grow at a high rate. Membership income growth was up by about 14%. Now, one of the other things we have to make note of, and I think a lot of people seem to be missing this, is that digitally enabled comparable sales is actually up over 20%. 20.5%. This is a business segment that's been growing rapidly for this stock. So there's no doubt Costco is absolutely a high quality company. There's a reason investors are such a fan of this business model. But with that being said, it's come at a price, a very, very expensive price. And in fact, when we look at this company and you're trying to figure out what's the reason for such stark underperformance in the last year, I think it was simply due to valuation risk. If we jump over to the charting tab here on Seeking Alpha, and we just simply look at the price to earnings multiple for Costco for the trailing 12 months over the last year, we can see to start the year, the price to earnings multiple was sitting at 58.37. It climbed even higher. It got above 60. Now remember, a price to earnings multiple by itself doesn't tell us enough about the business. It depends on how fast the company is actually growing their earnings. And while Costco is a great stock, if we look at earnings estimates, we can see they're typically sitting in that 10 to 11% range. Now, that's good growth, especially for a company like Costco, but not enough to justify a price to earnings multiple sitting in the high 50s or low 60s. So naturally, the stock continued to sell off, and it's pushed the price to earnings multiple down to about 48, at least on a trailing 12 months basis. But if we look at the company now and look at that forward PE multiple, it's still relatively high at about 43.55. So the question is, with the stock selling off about 12% in the last year, now at a 52-week low, has Costco again become interesting at these prices? Well, to put in perspective just how much of a premium this company trades at, let's use a reverse discounted cash flow analysis. We'll come up here and plug in Costco. What we can see, if Costco grew free cash flow in the future at 0%, the stock would be worth $207.84 per share. Now, obviously, they're trading at $884, so growth is priced in. But how much? Well, if we plug in 5%, it jumps to $293. What if we bump it up to 10%? It's at about $413. Now, again, remember, this is around the range that analysts are expecting earnings and free cash flow to grow in the future. Maybe it'll be a little bit higher at 11.5%. But even then, the stock would be worth $458 per share. If we bump this up to 20%, 22%, maybe around 21%, we finally start getting close to the range that the current price is. This is astronomical growth. They are priced at a ridiculous premium right now. Now, that being said, the business model, yes, it's absolutely phenomenal. The cash flows are unbelievably stable, growing at a healthy rate and very predictable. But there's still immense valuation risk with this stock. The stock is a buy and hold forever if you can buy it at the right price. There's no doubt it could absolutely start to climb higher if people want to bid it up and continue to pay the premium. That's just not something I'm willing to do still at current prices. Next on the list, we have the Procter Gamble company, stock ticker PG, trading at $140 per share, and in the last year, now down 17.5%, year to date down over 16%. But trading at these prices with the recent sell-off combined with dividend growth, we can see that starting dividend yield is now around 3%. And of course, this is a Dividend King stock with over 50 consecutive years of dividend increases. Now, the dividend growth has been pretty much in line with their free cash flow growth, which is typically what you want to see for sustainable dividend growth. It's the reason the free cash flow payout ratio has essentially stayed in its same healthy range, currently sitting at about 56.35%. So if you ask me, I think that's decent capital allocation. Now, obviously that depends on a multitude of variables, but just generally speaking, this is what we want to see for sustainable dividend growth. Now, Procter & Gamble released their latest quarter's earnings not too long ago, and there's a couple of different things that we do need to make note of. To start, they outlined up to 4% in organic sales growth for 2026 as restructuring targets agility and innovation. The company also expects core EPS growth of in line to plus 4%, which for reference, if we look at how they've historically grown earnings, let's go ahead and look at the stock screener. What we can see is revenue growth has been quite slow. In fact, if we look at earnings growth, let's just jump over to the profitability sheet real quick and look at PG. We can see their 5-year revenue CAGR is sitting at just 4.42%. So revenue growth has been slow for some time now, but the good news is the gross profit ratio has climbed slightly. It's not a lot, but that does help boost earnings growth. This is the way a lot of Dividend King stocks, companies that are much more mature, find ways to grow earnings. Now, with that being said, we can see the stock is still trading at a forward PE multiple of right at 20. Now, historically, they've traded at a PE multiple that's closer to the range of around 25, as we can see here. So they're trading at about a 17 to 18% discount compared to how they've historically traded. With that being said, if we jump over to our stock valuation sheet and come up here and plug in Procter & Gamble. Again, let's use the dividend discount model for our valuation for Procter & Gamble. Now, again, we're valuing the stock based on how much to pay out in dividends, how much that dividend is growing over time. And what we know is based off recent dividend information, the starting yield, yes, around 3%, but the 5-year dividend CAGR around 6%, but it's likely this will be closer to the 4% range if they continue to grow free cash flow and revenues in that 4% range like the company has guided towards. And historically, they've grown dividends at about the same rate as free cash flow. So what would the results of this be? Well, let's go ahead and plug it in. At 4% dividend growth, the dividend discount model price per share would only be about $96.53. But maybe you think that's not a fair valuation. Maybe we should look at them from a sensitivity valuation perspective. Again, let's look at Procter & Gamble. We can see the projected EPS CAGR about 4.37%. So again, let's just stick with that. And then if we remove the one outlier here in 2019, when the PE multiple climbed to about 70, we can see the average PE multiple over the last decade is about 23, which right now we're about 12% lower. So even if we see the multiple revert closer to that 23 range, forward-looking returns still don't look very good at this price. Now, the reality of what we're looking at here is that stocks that grow earnings at a very slow rate absolutely warrant lower PE multiples. So while the stock has been selling off, it could continue to go lower. I absolutely think that would be reasonable. For me personally, at this price, I still don't have any interest in Procter & Gamble. A stock trading at a forward PE that's only growing earnings at about 4%, in my opinion, is not attractive whatsoever. Now, with that being said, we have to remember, we have to think of investments through the lens of the dividend growth pyramid. I've talked about this a few times before. But at the bottom, we have these high yielders that typically have a high starting dividend yield, but maybe don't grow the dividend at a high rate. And then at the top, we have the low yielders that do grow dividends at a high rate. Procter & Gamble's somewhere here in the middle, considered a more defensive, durable business model, but they're not necessarily a high yielder, but they're also not necessarily growing dividends at a high rate. So I think the argument a lot of people would make is that it's a defensive play. Maybe that's the case depending on your situation, but if you're a long-term investor like me, I don't think this company is ideal. And then finally, our fifth stock that's truly trading right at its 52-week low is Zoetis, stock ticker ZTS. In the last year, they're down about 33%, and year-to-date, down over 26.7%. Now, this is a stock I'm excited to mention because I was actually writing about it over on Dividendology.com just the other day. Every single month on Dividendology.com, you'll get an email from me on the list of the most upside dividend stocks. Now, these aren't stocks that I hand select, but instead, I compile data on all Wall Street price targets and then find the stocks that, according to Wall Street, have the most upside and and Zoetis was one of the stocks on this list. The average Wall Street price target is about $167, which would give them over 37% upside at current prices. Now, if you aren't familiar with Zoetis, they're the world's largest animal health company, providing medicines, vaccines, diagnostics, and treatments for both companion animals and livestock. And they have a long history of growing dividends at an exceptionally high rate. The starting yield is around 1.7%, but their 5 and 10-year dividend CAGRs are both right at around 20%. And for the past 10 years, this has been backed by growing free cash flow. But in the last 5 years, free cash flow growth has slowed down a little bit, but it still looks quite solid at about 11.5%. But what we can see is the free cash flow payout ratio has climbed a bit since dividends have grown at a faster rate than free cash flow. But with that being said, it's still sitting at just around 34.2%, which by all means is considered very, very healthy. If we go ahead and jump over to our stock screener and look at Zoetis, one of the things we have to make note of is return on invested capital for this stock has been climbing in the last few years. Historically, it's been in that 15% range, but has climbed all the way to above 20% as of 2024. So essentially, the projects the company is reinvesting back into are becoming more profitable. Again, this is a great sign. It's exactly what we want to see. Now, a simple analysis of the sector/industry that Zoetis participates in shows there is rising pet ownership throughout the world, higher spending per pet, and global growth in protein such as cattle, poultry, and pork. This is one of those things where you really don't even have to dive into the numbers. If you just pay attention to the world around you, you already realize this is the case. So what do forward-looking returns look like at their current price? Well, let's look at the sensitivity model. Right now, their projected EPS CAGR is about 8.85%, and what we can see is, historically speaking, they've traded at a very high PE multiple. And what we can see, historically speaking, is they've traded at a very high PE multiple, about 53% lower right now than they've historically traded. Now, with that being said, they used to grow earnings at a faster rate, so the lower PE multiple is absolutely warranted. But even if we see just a little bit of multiple expansion, maybe it climbs to around 21, all of a sudden you're looking at market-beating returns compared to historic market averages. So I think Zoetis has finally gotten to a price where forward-looking returns start to look attractive. So there you go, those are 5 stocks currently trading right at their 52-week low. Again, if you want access to my best research, be sure to check out dividendology.com at the link in the description, or simply scan the QR code that's on the screen right now. And like always, if you want to be able to download any of these spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.